Welcome back. It's earnings time. Bank of Baroda impressed with a lower NPA and hence a much lower than expected credit cost, or what you call provisioning for bad loans. But deposits and advances growth have been soft like in all other banks. Margins are hit by higher deposit costs. Joining me now is Mr. Debadatta Chand, the Managing Director and CEO of Bank of Baroda. Mr. Chand, good morning and thank you very much for sparing time for us. Well, first up, your margins have held up the same pressure that others have felt. But do you think you are going to see a higher cost of funds because of the LCR requirements?
Good morning, Latha, and thanks for inviting me. A couple of things that went for this quarter. Clearly, we wanted to realign the balance sheet in terms of the liability management. And if you look at the growth both on the advances and deposit, these are in line with the market, but we could have grown a couple of percentage higher. But we wanted to reduce the dependency on the bulk deposit.
Yes.
If you look at the cost pressure, in fact, the cost of deposit was increasing almost like 10-11 BPS quarter to quarter. And if you look at the June quarter vis-a-vis March, it is the flat level. So we have a better control on the cost of deposit now, and the outcome is that the margin is maintained. We had a full year NIM of 3.18, and this quarter again the same 3.18 we have. So I think we're in a much better position in terms of looking into giving a stronger growth from the next quarter onwards. Because not only on the margin side we have hold on to the margin, at the same time the dependency on the bulk we have reduced significantly. Third, slightly the fine price asset, which are high quality of course, we have reduced that. And on the capital front also significant jump in the capital also.
Oh, capital. Yes, I'll just come to the capital in a minute. Just on cost of funds, do you have more elbow room to reduce bulk deposits? And secondly, what is the extent to which you have to increase deposits at all? Because I think you are sitting in a comfortable LCR. It's what, 130 or something, right? So
we are at 138, yeah.
Okay, so will you just bring it down to what, 120 and be happy about it?
Yeah, absolutely. These are all management of multiple factors they are in. The moment you look into LCR 138, even if the draft guidelines comes into finality, the impact would be something around 12 to 15% maximum. So we'll be at a comfortable level. The same time, as far as bulk is concerned, if you look at as far as we are concerned, FY23 over FY22, the percentage of bulk as a percentage of total deposit went up by almost 600 BPS. And now in June 24 also, we are almost at the same level as far as the percentage deposit concerned. So in the process, we have made the deposit profile much more stable at the same point of time, keeping the margin also intact. So from here onwards, I can think that I can play around with that margin because the margin guidance we are giving 3.15 plus minus 5 BPS. So depending upon the outlook on the loan side in terms of their pricing, I think we can still increase the bulk, but obviously keeping the margin factor into mind while increasing the advance.
3.15 is for the full year, I would assume.
This is for the full year, plus we have given a guidance of plus minus 5 BPS. That is what we have been telling for multiple quarters now.
Okay, but more generally, cost of funds will go up, you think, because there is a war for deposits?
There are two scenarios panning out. Actually, the cost of deposit not only depend on the rate stance, but also the available liquidity in the market. And what we are seeing for a couple of weeks now, that it's now getting better than the earlier. So my sense is that even if on the rate stance, things may continue as it is, but because of a better availability of liquidity, possibly cost can moderate. But that may not happen immediately, but slightly I may looking at Q3, maybe the cost of deposit would moderate. So in that scenario, it would give further leeway for us to increase on the advances side.
Okay, and not all banks are agreeing. HDFC Bank just raised its deposit rate on several tenors. So many of the banks told us that the pressure continues at least this quarter. Let's see if the government, the RBI cuts CRR or something. Okay, let me come to the slippages part. Your retail loans did show some slippages, I think 1.7%. How is it shaping up? Can it get worse in the current quarter?
No, I don't think so. Reason being because we map out the SMA book on the retail and also the collection efficiency. Both are at this point of time quite strong. So I don't think this retail slippage is some kind of a seasonal one-off kind of a year. And if you compare the slippage ratio vis-a-vis the Q1 of the last year, it is much better. And the credit data also showing much, in terms of the Q1 of the last year and Q1 of this year. So I don't think that going to continue. It's something one of seasonal, and I think will be like, because we look into these accounts more closely, I think a lot of pullback could happen out of the slippage that happened for this quarter in the Q2. So things are fairly stable in terms of the asset quality.
Okay. Yeah, of course, you'll have done extremely well on recovery and upgrades. And I must admit that a lot of other banks' annualized slippages are higher than yours. Mr. Chand, now to come to the other two small, minor overhangs on the banking system. If the project finance provisioning rules come, how much can your provisioning go up?
See, last time also the same, because it's a draft guidelines as a policy, we normally, because unless and until the final guidelines comes, we can't actually take a call on that. But considering my scenario, see, a couple of scenarios, let me tell you very clearly. One is that my capital adequacy is very strong, and that is out of internal accrual. The second is the margin is also fairly good considering the market, in terms of the market scenario. And thirdly, in terms of my dependency on the bulk on the cost side, not only on the interest cost, but we have also a strong lead on the operating expenses that would have seen. So as against a 25% growth earlier, now the growth is only 14%, 14.5%. So scenario like that, any impact because of the project finance, consequently, I give you a scenario like when the risk weight of the NBFC and this personal loan came, the impact was almost 68 BPS on the CRAR. But currently, if you look at the CRAR is much better because the banks normally do pass on the impact therein. So I think any guidelines coming on the matter on the project finance, I think the bank's balance sheet is well capable of handling that, or that may be a scenario where we can pass on to the customer to recover the impact there.
Okay. You have taken board permission for 7,500 crore of additional capital, right? Are you likely to do that very quickly? Market is at 25,000. It is in the best of spirits. So should we expect, and will it be an offer to the public, or will it be privately placed?
No, it will be privately placed. That is one. Secondly, if you look at my CRAR, there is no urgency for me to raise this capital. That is very clear. And sometimes, particularly long-term capital bond, it also depends upon the market appetite. At the same time, the rate stance. So our own house view with regard to the rate stance is that possibly expecting a Fed cut maybe in the month of September, and consequently a bit of moderation happening on the rate stance. That is what our expectation is. So we'll be timing it in a manner where we get an optimum, interest cost in the issuance side. So it's not immediate, but there would be maybe this quarter or next quarter possibly will be hitting the market.
Okay. Well, finally, if you can give us some idea of where growth will come from, what kind of growth in advances are you penciling in, and from which verticals?
See, if you look at the current year retail, we are doing the growth has been more than 20% for last many quarters now, and this quarter also the retail is more than 20%. And if you compare the Q1 of the last year and Q1 of this year, the change in retail is almost 250 BPS. Towards positive. That means we have increased the retail book. And typically in the bank, we talk about retailizing the book, and slightly that is what it has worked. MSME and Agri this quarter slightly below 10%, but there we would like to grow slightly higher. We are targeting something around 14-15% growth in MSME and Agri. Particularly the budget is giving a lot of support for the MSME. I think that would be an achievable one. Corporate side, we have strong pipelines. And as I said, corporate, it's a how do you balance the portfolio? That is important. There are strong demand from the renewable side, on the infra side, even on the cement and some other core side also. So the pipelines are quite strong as on today, as far as we are concerned. And I think on the corporate side, we are giving a guidance of 10 to 12% growth for the full year. And I think we'll be in a position to achieve. So the overall loan guidance for the full year is around 12 to 14%. And I think currently, based on the pipeline, our capacity to grow because of a strong CRAR, good margin, I think those are things which can be achieved by the bank for the full year.
Okay, your full year credit cost guidance was?
See, this time the best part of the credit cost is below 0.5, but earlier we had given a guidance that we'll maintain credit cost less than 1. Keeping everything, the ECL framework, everything in mind. But this time we have again revised it to less than 0.75. And as far as Q1 is concerned, we're at 0.47. So in that way, fairly balanced and well positioned therein.
Okay, below 0.75, that's, well, let's hope it's 0.5. Thank you very much, Mr. Chand, for joining us with all those details. So, Bank of Baroda promising good growth and, of course, lower credit cost, which is what the street wants to hear. Wrap up on Bazaar on that note, with the market still cheering 25,000. Chartbusters will take the action for.